The economy has been on a two-track path for most of this year. And by two tracks is we've had very, very strong consumer spending. And that's been accompanied by very, very weak business investment. So that's normally doesn't happen that way. Normally both are going up at the same time. But in fact, consumer spending has been very strong, and business investment has actually contracted in both the second and third quarters. So we're going to try and explain what's going on. All right, so one of the things I want to say is we're a little bit more optimistic than last quarter. We've had a 3-2-1 forecast for a while, which was 3% in 18, 2% in 19, 1% in 20. It's now probably 3-2-2. We have 2% in 2020 instead of 1%. So we've marked up our forecast a little bit for next year because stocks have made a new high, and we were worried that they were in a trading range for 18 months. The Fed balance sheet is once again expanding instead of contracting. The yield curve, which uninverted. Housing seems to be better than what we've had it. Employment seems to be better than what we previously thought. So we put all that together. It says maybe a little bit better in 2020 than what we previously thought. The other thing is we think consumption, though, isn't going to hold up as strong as it's been. So we're going to have consumption weakening a little bit. And then we're going to have business investment modestly improving. So it'll be both running around 2%, something like that, 2% track. So a little slower on the consumer side, a little stronger on the business side. On the consumer side, we're especially worried about automobile sales, and we'll get to that in a little bit. The other thing in the forecast is employment growth is decelerating from 170K a month, which is what we averaged thus far this year, to about 80K a month next year, and maybe 50 or 60K in 2021. Unemployment bottoms around 3.4. It's around 3.6 right now. Some forecasts have unemployment going to 3.2. Interest rates, we think, will remain low in a very narrow range, and we'll have 2+% inflation in this time. So real yields will be negative for the period. And we're in an era of trillion-dollar deficits, and the deficit's going to stay $1 trillion as far as we're only going out to 2021. But if we went out to 2030, we'd have $1 trillion. We'd have $1 trillion deficits, and the deficits are really being subsidized by very low interest rates. They'd be much higher if we had normal interest rates. All right, first thing is the stocks have broken out to new highs. They were in a trading range, if you notice, from January of 18 until September of this year, and then stocks have broken out. That should help investment, and it also should help a little bit on the consumer side. The next thing is the Fed is now expanding its balance sheet. The Fed basically was on a process of normalizing its balance sheet and basically wanted to take away some of the expansion they put in the system from QE1, QE2, QE3, and was reducing its balance sheet. Then in September, what happened is they had a plumbing problem. That's the only way to explain it. And they needed Roto-Rooter basically to come in and fix the plumbing problem. And the plumbing problem arose because the reserve requirements of the Federal Reserve are less than what the liquidity requirements of Dodd-Frank is, which is the big financial control for large, financially significant institutions, large institutions. So what happened is the Fed funds rate, instead of being around 2%, went to 5% for a couple of days, and they didn't know what was going on. It caught the Fed by surprise. And they realized they cut reserve balances. They cut reserve balances too much. Their balance sheet shrunk too much. And all of a sudden, they had to start increasing their balance sheet. Although Chairman Powell says this is not QE, this is not QE, this is not QE, quantitative easing, it has the same effect. It has the same effect as quantitative easing. And they undid, in the matter of 2 months, they undid 40% of the balance sheet reduction they had over the previous year and a half. So the Fed is expanding its balance sheet, and it showed up right away in stock prices and also eased financial conditions. The other thing is we've had this negative yield curve and an inverted yield curve. And whenever we've had inverted yield curves, here, 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 a recession follows, like night following day. And the thing is, this is something we're concerned about. Although the thing is this time, even though you're not supposed to say this time is different, because those most dangerous words you could say in finances, is in part it's been only a short period of inversion. And then the second thing, this inversion really occurred from a collapse in long-term yields rather than an increase in short-term rates forced by the Fed. So in Wall Street terms, this is called a bullish flattening as opposed to a bearish flattening. And so we think maybe this time might be different, but it is something to worry about, because if you notice, the curve always uninverts before the recession. And this is what's happening right now. So Ed's going to talk about that as one of his indicators. Something we worry about, but we think this time might be a little bit different than history. Okay. Here's the consumer spending. We had north of 4% growth in the first quarter, around 3% in the third quarter, and it looks like it's going to slow down. Now we have a big contraction coming in the third and fourth quarters of next year due to our concerns about what's going on in the automobile market. So consumer spending, instead of being really red hot, is going to sort of be more normal, aside from a slowdown in the second half of 20. And here's business fixed investment. And if you notice here, 2 negative quarters. If you take a look, we had one in 2015, a couple there, but normally in expansion, these things don't go negative, but they're negative. Now, what's causing that? One is businesses don't understand what to make of their supply chains, given all the trade tensions going on in the world. So you have businesses reluctant to invest in supply chains because they don't know where their suppliers are going to actually come from, given the tariff issues. The other thing going on is there's been a huge contraction in oil and gas investment, which came when oil prices dropped a year ago from $70 to $40 a barrel, and we've had a big pullback in oil and gas construction. Oil well construction, oil field construction, is bigger than commercial construction, and normally as a sector. So this really is a big hit to business fixed investment. The part of business fixed that's still working is intellectual property, which is cloud computing and streaming video, and we see that all over LA with the big growth and all the companies doing streaming. My guess is that will hit the wall in 2020. I have a bet with somebody on this, a dinner at Musso Frank's, that I and my bet is this hits the wall at the end of 2021 or the beginning of 2022, because there's not enough hours in the day to watch all the streaming content that's being put out. So we're going to find out who wins and who loses. Here's our concern about cars. Cars have been running 17 million units. Most people have car sales down for next year. We have them down by a lot more, down to around 15. It goes below 15 a little bit, because we think there's real credit problems surfacing in the whole automobile market. And it's coming from this. That's a Jeep Cherokee. There's an article in the Wall Street Journal, November 9th, 2019. $27,000 Jeep, you get $45,000 loan. This is prevalent. We had somebody yesterday at our session, at a seminar session yesterday, and they told us they were very, very conservative with auto lending. They will only lend up to 120%. They'll only lend up to 120% of a car's value. This stuff gets securitized. It's the same thing like the subprime market. These are subprime automobile loans. They go to Wall Street. Delinquencies are beginning to rise. And when the securitization market says we don't want to take this anymore, all of a sudden you'll have a big credit contraction in automobiles. And when that happens, say in the second half of 2020 as we modeled, or sometime in 21, this is an inevitability. It's the same thing that happened in 05, 6, and 7 when we had 110, 120% loans on houses. But unlike houses is you buy a house and presumably the value is the same when you move in. As soon as you take a car off the lot, it's worth 20% less as soon as it's driven off the lot. So this is one of our big concerns for next year is automobile credit. Here's the GDP forecast. We're around 1.5 for the fourth quarter. We started the quarter, most people were looking at 1%. Now some people are 2. We're around 1.5. We'll see. We go a couple of percent. We go over 2% in the first half of next year, then down to 1+. Our previous forecast had a 0.5%. Now we're like 1.25% for the second half. That's the increase in our forecast. And then we're back to 2% growth in 2021. So that's our basic GDP forecast. Payroll employment continues to grow, but it stalls out a little bit in 2020. The little acceleration you see there is hard to see in next year is census hiring, and then the flattening out is they lay off the census workers. They're just temporary hiring by the federal government. But we have employment growth slowing, as we were saying, from the 170,000 a month to maybe 80,000 a month next year, 60,000 a month in 2021. Still okay, but the growth path will be a lot slower because we think we're at the stage where we're beginning to run out of people. Here's the unemployment rate, bottoms at 3.4 and then gradually increases to 3.8. Still stays well below 4%. And it's going to be a very sustained period of like 3 years of sub 4% unemployment. So that's it's a reasonably good labor market. Okay, here's our view on rates. Is Chairman Powell at his news conference of September, if you really listen closely, really laid out two important facts. He said, one thing he said, there'll be a very high bar to lower rates from here. He was very clear about that. So don't expect Wall Street, you keep expecting rate cut, rate cut, rate cut. He said, we're done, at least for the time being. And to get us to cut again will take a lot. He also said there's an even higher bar to raise rates. So the thing is, in order to get him to raise rates, you need a strong economy, and you also need inflation sustained above 2% for a long period of time, not just for 1 month or 2 months or 3 months, but for a sustained period of 2+% inflation, which is their target. So as a result is we have a very narrow trading range for both 10-year treasuries between, say, 1.5 and 2.25. And we have the Fed funds rate. We have one more rate cut in end of 2020, and the reason is we have that weaker economy that the Fed doesn't have. So that's the reason why we have one extra rate cut, is when we go down to around 1%, 1.25% in the second half, we think the Fed will go again. And then we raise it in the fourth quarter of 2021 just to show we don't think they're going to stay down forever. So we just want to show one rate increase at the end. And it's also we'll have a couple of years of over 2% inflation. So that's sort of thing. Now, if you want to say we're being too cute by half, you could say that, and we could leave it the funds rate at 1 3/8 instead of going to 1 5/8. But the headline inflation has been above 2%. Now, the Fed uses something from the GDP inflation account, the consumption deflator. We're using the consumer price index, which I think is more representative of what people are actually paying rather than the PCE anyway. So that's also above 2% for a sustained period of time, and that's our argument for a rate increase late in 2021. But it also means real rates at the short end and the long end are either going to be zero or negative going forward. This is a very stimulative environment. This is a far cry from what they were talking about normalization a few years ago. Okay, housing, we marked up our housing forecast, and we still might be low. We think we'll be around 1.25 to 1.3 million units a year running at. Historic housing construction is between 1.4 million and 1.5 million if you go back 50, 60 years. That's what it typically runs at. Practically every time in the past we've been too optimistic about housing starts, so we've always had to lower them. This is the first time I'm beginning to think we may be a little bit pessimistic and maybe a little bit better than what we have here. So instead of 1.25 to 1.3, it may be 1.3 to 1.3.5 or something like that. That seems to be doing a little bit better. So basically, the recent run rate, what we're seeing recently, this is what we're gonna get. In our forecast, one of the things that made us a little bit more optimistic is we thought that there'll be some progress on trade. Now the thing is, this was going along fine until our president opened his mouth the other day. And all of a sudden says, I don't care if we get a trade deal, maybe we do it after the election. So stocks fell out of bed, so stocks dropped 1% one day, 1% the next day. But then they said, today, he said, and Wall Street's like a Pavlovian dog. They said, well, maybe they said the trade talks are going well. That's what he said this morning. And lo and behold, the market's up. Stocks are up this morning, and it just responds like a Pavlovian dog to this. The key on all of this is going to be December 15th is the big day. Because on December 15th, he announced there'll be a whole bunch of increases in Chinese tariffs, a substantial increase across the board on Chinese tariffs. If that happens, our forecast is way too high, and the real growth will be a lot less, and interest rates will be a lot lower if that happens. So December 15th is the date to watch on this. Now here is our export economy, and exports have been facing a real problem because in the face of the trade war, there's a soft global economy, there's tariffs and a high dollar. Now the big increase we have here, we also had that in the investment right here, this big increase in exports in the first quarter. We're making a modeling assumption that the 737 MAX airplane is certified and ships in the first quarter. Now, it may not all happen in the first quarter, it may be the first or second quarter. One of the risks in the forecast is that that bird doesn't fly. And if the plane doesn't fly, then you're going to have layoffs all over the country. Boeing is still producing airplanes at the rate of 42 a month. So all the supply chain has not been disrupted with the grounding of the airplane. It used to be producing at 58 a month, now producing 42 a month. If those planes don't ship, if the planes don't fly, they don't get certified, all of a sudden they'll stop the production lines and you'll have layoffs all over the country associated with this. So it is a big deal. We're assuming first quarter they deliver. Now it may be, given that where we are in early December, it may be first and second quarters where we begin to see deliveries of those planes. Now, a lot of it is just coming out of inventory into exports. So inventory drops, exports go up, inventory drops, equipment spending goes up, but won't really affect GDP all that much because it's a subtraction on one end and an addition at the other. So that's a big deal. It's something to really watch for the macro economy. Here's the federal budget deficit, over $1 trillion, and just stays there. And to conclude is we have 2% path with a temporary slowdown in the second half of 20. Spending growth, the consumer slows as business shows modest increases. We worry about auto credit and auto sales, interest rates in a low trading range, housing starts stable in 1.25 to 1.3 million units, and the era of $1 trillion deficits are upon us. So thank you.